press the bell icon on the YouTube app and never miss another update.
Let's discuss certain special situations with respect to Ind AS 12. Have you really wondered how will you determine deferred taxes if there is a business combination? By business combination we mean some form of amalgamation or maybe some form of absorption. So let us say you are taking over some another company. When you are take over some another company, its assets and liabilities will be incorporated in our books. And if you recall amalgamation, then in case of amalgamation, we can record these assets and liabilities of the selling company in our books at its fair value. So it is a special situation because you will be incorporating the assets and liabilities at its fair value. You have to compare with its tax base. There will be even a point of goodwill also. And on the basis of that, we will have to also compute the deferred taxes. However, I am not discussing this special situation over here because we have still not done business combination. Business combination is covered by Ind AS 103. So once we do Ind AS 103, at that time we will discuss what exactly will be the treatment of the deferred taxes. So although it is a special situation mentioned in Ind AS 12, I reserve it for a later discussion for a simple reason that we are still not aware about the requirements of Ind AS 103. So this is the first special situation mentioned in AS 12, but for the moment, as far as we are considered, we are ignoring it for the moment. Let's discuss the second situation, which we will definitely discuss with context to Ind AS 12. Let us say as on today you are doing a particular transaction and the transaction is such that the carrying amount of asset or the liability does not equal to its tax base. Right, I am saying this is something that is happening on the date of transaction. So let us say you are doing a transaction as on today and the transaction is resulting into the difference between the carrying amount of the asset or liability and its tax base. One more thing. This transaction should not be a part of business combination. So it's not that we are taking over some another company and because of which we are having this kind of a situation. No, it is a regular transaction that you are doing as on today. And as on today, you find out what is the carrying amount for your balance sheet. And then you also figure out what is the tax base and the two are not equal. We know that if two are not equal, then it will result into a temporary difference. That temporary difference can be a taxable temporary difference or it can be a deductible temporary difference. And on that we know we are supposed to calculate the deferred taxes. So the special situation is that if this transaction does not have any tax implications, right? If this transaction does not have any tax implications, then do not recognize any deferred taxes. I will again repeat it in case if you have missed it out. Just try to understand what we are trying to say. Let us say on a day of transaction, let's assume as on today. So as on today you do a transaction and on that particular date of transaction, the carrying amount of the asset and the liability is not exactly equal to its tax base. Fine, there's no problem over here. The two are not equal. Understand, if two are not equal, then the difference will be the temporary difference. Depending upon which carrying amount is higher, it will all result into either taxable temporary difference on which I should calculate deferred tax liability, or it will give rise to deductible temporary difference on which I should recognize deferred tax asset. But what the special situation is that if this transaction is not a part of business combination, that's one thing, and if it does not have any tax implications, then do not recognize any deferred taxes. See, it makes a lot of sense. If there is a transaction which will not have any impact of taxation, right? It does not have any impact on taxation, then what is the point of recognizing a deferred tax asset? What is the point of recognizing a deferred tax liability? I will altogether ignore that particular transaction. We have a question based on this. We can solve that question over here. Question 13 is what I would like to cover here. So it will help us understand the special situation in a far better way, because the moment we will get some figures, it will be easy for us to understand. Yes, question 13, it says, Entity A acquires a foreign made vehicle for rupees 1 lakh directly from the vehicle manufacturer. The transaction is not a part of any business combination. The tax laws do not permit any depreciation thereon. Also, any profits at the time of sale are not taxable or losses are not tax deductible. How shall it be treated as per Ind AS 12? See, you are acquiring a foreign made vehicle for rupees 1 lakh. Don't ask me which foreign made vehicle is available in 1 lakh of rupees. That is not really the case here. What they are saying is that you are acquiring a vehicle for rupees 1 lakh of rupees. Fine. So if I talk about the carrying amount of asset, right? So I said carrying amount of asset in balance sheet. So obviously I'll be recording this vehicle at 1 lakh of rupees. After all, this vehicle is an item of PP, and we know that PP will be recorded at its cost. So I'm recording at 1 lakh. Now I have to find out what is its tax base. I hope you still remember the tax base of an asset. Tax base of an asset will be the amount deductible for tax. Now what they are saying is that the tax laws do not permit any depreciation thereon. So I cannot claim any depreciation. If I cannot claim any depreciation, that means I will not get any deduction at all. If I am not getting any deduction, that means the tax base is 0. Now the difference, I am writing in short, temporary difference. The temporary difference is turning out to be 1 lakh. Right? So the temporary difference is 1 lakh. And because the carrying amount of asset is higher than the tax base, this is taxable temporary difference. And on taxable temporary difference, we should be recognizing deferred tax liability. But we will not recognize any deferred tax liability over here. Why? Because this is a transaction which is not a part of any business combination. That's one thing. And second, it does not have any tax implications. You will not get any deduction for depreciation. Then they are saying if you are selling this particular vehicle, then the losses will also not be, losses are not tax deductible. If there is any gain, then that gain also is not taxable. See, it does not have any tax implications at all. And when it does not have any tax implications, where is the question of paying higher taxes? Or where is the question of saving taxes? And that is the reason we should ignore this transaction. So in spite of having a taxable temporary difference of 1 lakh, right over here, I have a taxable temporary difference of 1 lakh. In spite of that, we will not recognize any deferred taxes. In short, we will be ignoring it. We'll put an answer for this particular question. Please do write in your notebooks. I'll just dictate the answer, so please carefully listen to it and write it down in your notebooks. Yes, question 13. As per Ind AS 12, please write in your notebooks. As per Ind AS 12, comma, if carrying amount of asset or liability is not equal to its tax base, at the time of its transaction, comma, where the transaction is, put a dash, write in a new line, A, not in the nature of business combination, not in the nature of business combination, and write in a new line, B, not impacting either the accounting profit or the taxable profit then put a dash and write in a new line, neither DTL nor DTA is recognized. Neither DTL nor DTA is recognized. Full stop, write in a new para. In the given case, comma, on the date of transaction, carrying amount of asset is rupees 1 lakh. Carrying amount of asset is rupees 1 lakh, but its tax base is 0. Full stop. Transaction is not a part of business combination. And does not impact accounting as well as taxable profit. Full stop. No DTL, deferred tax liability. No deferred tax liability is to be recognized. As per Ind AS 12. No deferred tax liability is to be recognized as per Ind AS 12. Yes, having said this, let's discuss the third special situation. This special situation is with respect to investment in subsidiary or a branch or an associate or a joint venture. Yes, understanding of consolidated financial statements will be slightly necessary to understand this particular special situation. Right? You should have a working idea of the way the investment is done, or rather I'll say the way the investment accounting is done when you are buying shares of a subsidiary or a joint venture or an associate. Now what exactly is the special situation over here? Let us say on 1st April, okay, let me write here. Let us say on 1st April 19, A buys 80% shares of B. The moment you are buying 80% shares, that means you are having more than the majority of the shares. And when you have more than the majority, what will happen is you are in a position to control the company. So A will be considered to be the parent and B will be considered to be the subsidiary. In other words, you are establishing control, right? A is in a position to control B. Let us say this 80% shares has costed you, let us say, rupees 100 lakhs. Now, in the year 2019-20, let us say, B reports profit of rupees 10 lakhs, let's say. So the year is coming to an end and B as your subsidiary has reported a profit of 10 lakhs of rupees. Now when it comes to company A will prepare separate financial statements. A will also prepare consolidated financial statements. See, A is an independent company. If A is an independent company, it has to prepare its independent balance sheet. It has to prepare its independent P&L. This independent balance sheet and the independent P&L, that we refer as separate financial statements. And when you consider B and A, right, the parent and subsidiary to be one single economic unit, and then you prepare the financial statements, that is what we call as the CFS. The point that we are discussing is not with respect to CFS. The point that we are discussing is with respect to the separate financial statements. See, what will happen in consolidated financial statement is, in consolidated financial statements, you will eliminate, you will cancel the investment that you have made in the subsidiary. You will find out the result in goodwill or the bargain purchase gain. So the investment in the subsidiary is fully taken care of. We are discussing what will happen in the books of A when A prepares its separate balance sheet. Now when A will prepare its separate balance sheet, A has a choice. Either it can show this investment at cost, or if it wishes, it may follow the equity method. Now normally equity method is followed for investment in associate and the investment in joint venture. But it's quite possible that parent may decide that it will like to follow the equity method. Let's understand what will happen in case of the equity method. Now if A decides to follow equity method, then we will start with the cost of investment. Right, in our example, the cost of investment is turning out to be 100 lakhs of rupees. If you are following the equity method, you will have to now add the share in post-acquisition profits. Right, after we acquired the shares, B has made a profit of 10 lakhs. Entire 10 lakhs does not belong to A. A is owning 80% shares. So 10 will be multiplied by 80%, so I get 8. And hence the carrying amount is turning out to be 108. So just see what has happened now. When A will prepare its separate financial statements, the carrying amount in balance sheet will be 108. I will have to now find out its tax base. Tax base shall be the cost of the investment. Taxation does not consider equity method. So income tax will be like that you purchase the shares for 100 lakhs. So as far as the tax base is considered, it will be 100. See, this is an investment. So this is carrying amount, right? I can say this is carrying amount of asset in balance sheet. This will be a better way of putting it. So the carrying amount of the asset in the balance sheet is 108, while the tax base is 100. So this will give rise to a temporary difference. So I have a temporary difference of 8. Carrying amount of the asset is higher than the tax base. This will give rise to taxable temporary difference. And on taxable temporary difference, you should be recognizing a deferred tax liability. So the special situation is, should we recognize the DTL? Yes or no? Very quickly, if you really missed out something, we are discussing a situation where A is controlling B. In our separate books, we are finding out what is the carrying amount of our investment. A has decided to follow equity method. So as per the equity method, the carrying amount is turning out to be 108. So in my balance sheet, I am showing this investment 108. I am comparing it with the tax base. This will be not considered by taxation authorities. And that's the reason my tax base will remain the cost, which is 100. So that means there is a temporary difference of 8. And this temporary difference is actually a taxable temporary difference. Should I recognize deferred tax liability on the taxable temporary difference? Now, what Ind AS 12 suggests is, are you in a position to control the reversal of that temporary difference? If the answer is yes, that you can control the reversal of temporary difference, then you should not recognize deferred tax liability. Are you in a position to control, right? What's the question? Are you in a position to control the reversal of temporary difference? Ask yourself, you have this temporary difference of 8. When can this difference reverse? You know, this difference will reverse the moment the subsidiary pays dividend. When you are following the equity method, I hope you still remember the equity method. Under the equity method, what we do is, we start with the cost of investment. To that, we add the share in the post-acquisition profits. And if there is any dividend, that dividend has to be deducted. So if you are receiving any dividend, then the dividend will be deducted and then you will get the carrying amount. So what will happen? This temporary difference which is there of 8, it will reverse the moment the subsidiary declares dividend. Just think for a moment, that the subsidiary declares dividend of 10 lakhs. You are reporting a profit of 10 lakhs and you are also, just assume for a moment, you are also declaring dividend of 10 lakhs. So you know what will happen here? After adding 8, I'll have to say less dividend received. Subsidiary pays a dividend of 10 lakhs. I will not receive entire 10 lakhs because I am owning 80%. So this 10 I'll multiply by 80%. I'll take 8 and I'll get 100. The moment I will put 100 over here, right? 100 and 100, that shall be no temporary difference. So this temporary difference will reverse the moment the subsidiary declares the dividend. Now what Ind AS 12 says is, are you in a position to control the dividend policy? If you are in a position to control the dividend policy, then do not recognize any deferred tax liability. Returning to this illustration, just think for a moment that dividend has not been declared by the subsidiary. So this is the situation that I am getting. I have a temporary difference of 8. So the question that I am asking myself is, should I recognize the deferred tax liability on this taxable temporary difference? Ind AS 12 says, are you in a position to control the dividend policy of this company? Because if you can control the dividend policy of the company, then the reversal of the temporary difference is also within your control. And if you are in a position to control the reversal of the temporary difference, then you should not recognize deferred tax liability. Since over here our relationship is based on control, tell me, the dividend that will be paid by the subsidiary, who will decide? The dividends to be paid by the subsidiary will not be decided by the subsidiary, it is going to be decided by the parent. So actually it is A which is controlling the dividend policy of B. As and when I wish, as a parent company, I can make the subsidiary pay dividend. And whenever it will pay dividend, this temporary difference will reverse itself. If the reversal of temporary difference is within your control, if the reversal of taxable temporary difference, I'll put it in that way. If the reversal of taxable temporary difference is within your control, then do not recognize any deferred taxes. Basically, you will not recognize the deferred tax liability. So, if you look at over here, right, these are the possibilities. As far as subsidiary is considered, I am in a position to control the dividend policy, right? If we go entity-wise now, as far as subsidiary is considered, even a branch is considered, we control the dividend policy. And because we control dividend policy, do not recognize any deferred tax liability. Let us analyze the case of associate. Let's think for simplicity that actually this company B is our associate. If it is your associate, then maybe you have acquired, let us say, 40% shares. So you have acquired 40% shares of this associate. What will happen here is I will get 40% over here. So this will turn out to be 4 and this will be 104. Forget about the dividend right now. So this is the situation that you will be having. So if it is your associate, then the carrying amount is 104. The tax base is 100. So again there is a taxable temporary difference of 4. So for associate also I have a taxable temporary difference. Question is that should I recognize deferred tax liability on that taxable temporary difference? The question asked by Ind AS 12 is again the same. Are you in a position to control the dividend policy? Because dividend policy is what will reverse this temporary difference. Tell me, ask this question for an associate. Can you control the dividend policy of an associate? In an associate, you have only significant influence. You only have a power to participate in the decision-making process. I am not able to control an associate. If I can control associate, then it will actually become my subsidiary, right? So it is a company where I do not control the dividend policy, right? So I do not control, when it comes to associate, I do not control dividend policy. If you cannot control the dividend policy, then recognize deferred tax liability. I should be recognizing DTL if it is an investment in associate. Finally, what about a joint venture? In case of a joint venture, whether I am in a position to control the dividend policy, yes or no? Now what happens in a joint control is, usually there will be a contractual agreement, and in the contractual agreement it will be clearly specified that are there any powers that the venturers are having. So basically you have to really study the joint venture. For example, let us say there is A and B. The two of them are coming together and forming a joint venture C, let's say. So you form a joint venture C. So A and B are having joint control over here. So we should study this entire joint venture agreement. By chance, if there is any clause in the joint venture agreement that the dividend policy will be decided by A, or there is something written that it will be decided by B, then yes, you have control over the dividend policy. But most of the times, no such clause will be there. The moment you say that company C is subject to joint control, then obviously A and B will sit together and with mutual consensus will decide what should be the dividends to be paid by the joint venture C. This will be the usual situation, but we cannot rule out a possibility that A may have some power to decide the dividend policy, or maybe B may have some power to decide the dividend policy. So one should just go through the entire joint venture agreement. By chance, if one of the investor, or rather I'll say one of the venturer, by chance one of the venturer has power to control the dividend policy, then for that venturer we should not recognize a deferred tax liability. But in case if there is no such thing, in case if it is A and B which have to sit together and then unanimously decide that what will be the dividend policy, that means even for joint venture also, you do not control the dividend policy. And if you do not control the dividend policy, you should be recognizing a deferred tax liability. Very quickly, if I again summarize the entire special situation, what we are saying is that we are calculating the carrying amount of investment. Put it in this way. We are determining the carrying amount of investment in subsidiary or a branch or an associate and joint venture, and we are comparing that with the tax base. Let us say the carrying amount is turning out to be higher. Because the carrying amount turns out to be higher, and since it's a carrying amount of asset, if carrying amount of asset is higher than the tax base, it gives rise to taxable temporary difference. On taxable temporary difference, I should be recognizing deferred tax liability. So what is the special situation? If it is an investment in subsidiary or branch, do not recognize the DTL because you are in a position to control the reversal of the taxable temporary difference because you are controlling the dividend policy of that subsidiary or the dividend policy of that branch. So don't recognize DTL over there. If you have an investment in associate, you are not in a position to control the dividend policy. So please go ahead and recognize the deferred tax liability. In case of a joint venture also, the same thing will be done. Even in case of joint venture, I cannot control the dividend policy and hence I will recognize DTL unless and until in the joint venture agreement there is specifically mentioned that one particular venturer will decide the dividend policy, then for that venturer we will not recognize the deferred tax liability. And finally, to wrap up this particular discussion, what if the company suffers a loss? Then what shall we do? We return back to the original illustration. Let's say you have acquired 80% shares for 100 lakhs, the original, and you are reporting instead of profit a loss of rupees 10 lakhs. So if you will follow the equity method, then your cost of investment will be 100. To this I'll say share in post-acquisition profits, but instead of profit there is a loss this time, so I write this as negative. I multiply that by 80%, so I get 8. So my carrying amount is turning out to be 92. I hope you understand what will happen this time. So I am getting carrying amount of 92. So I say carrying amount of asset in balance sheet, of course, it's turning out to be 92. Look at the tax base. The tax base will be the cost, which is 100. So I work out the temporary difference. The temporary difference this time is negative. Carrying amount of asset is lower than the tax base. When carrying amount of asset is lower than the tax base, this is deductible temporary difference. And on deductible temporary difference, we are supposed to recognize deferred tax asset. This particular difference cannot be reversed by controlling the dividend policy. And see, it's a loss. You can pay dividends when there are profits. When you are incurring a loss, you can't say I will declare dividend and reverse this particular difference. It's not possible. So Ind AS 12 now says, irrespective of whether you have investment in subsidiary, branch, associate, joint venture, everywhere the treatment will remain the same. And you know what is the treatment? Since this is a deductible temporary difference, you should be recognizing deferred tax asset. So go ahead and recognize DTA. Right? No, nothing like then subsidiary I will do and I'll not do here and I'll do there. No, nothing like that. Just go ahead and recognize the deferred tax asset. And for recognizing the DTA, you should follow the 3-step criteria. I hope you still remember those 3 steps criteria. Number 1, recognize DTA to the extent of availability of taxable temporary difference. Second, recognize the deferred tax asset to the extent future taxable income is probable. Right? And then the third one, if there are any tax planning opportunities available which will increase your taxable income, then to that extent you can recognize the DTA.
Press the bell icon on the YouTube app and never miss another update.